February 14th. Happy Valentine's Day. My wife surprised me with this morning, which is kind of funny. We can still do it all night long. And I'm going to cover up that part, or the other part there. Let me do it that way. Binge watching. Yes, so we're very good at that these days. Just one more episode, and we're up all night long. Anyways, it was an interesting week. Crappy week for me. I all will know if you're a regular follower. I was in Vegas last week for Super Bowl weekend. I'm sick as a dog this week. It's payback time. Anyways, we learned a lot this week in terms of inflation. The market response has me puzzled. Let's dig into the chart room. Okay, so core CPI is not the best measure. The Federal Reserve loves core PCE. There's this concept of super core, which basically really dials in and focuses on goods and services where labor is a huge part of it. So, you definitely see the inflation is coming not from the good side. We actually have a little bit of disinflation on the good side after having a supply squeeze there. But the service side is remaining, pretty elevated in the core and more concentrated in coming from the wage side. And I just don't see that ending anytime soon. So that's going to be a big challenge for the central banks of the world and the Fed. And basically, post numbers this week, we saw most of rate cuts priced out of the market, for 2025. Now, subsequent to that, the market started to price a little bit in. We've talked about a trading range here for TLT, the long end of the U.S. curve. So here's the gap down on the CPI. Market held in, tested a little bit of moderate support, held in a little bit, reversed. We got slightly better, not better than expected PPI, but it could have been worse kind of thing. And then Friday, we've got a really depressing retail sales report. Bond markets gapped down and rallied. A bad economic report that should rally bonds gapped up and they sold into it. So you had guys fading the extremes, and that really supports the idea of markets and many assets remaining range bound here, where there's too much uncertainty on the political front to know which way to take this thing and to make bigger bets and expand multiples and lower term premiums and it just range bound. So I think when we look at the next month, 3 months, 4 months, the first half of the year, it's amazing we're already halfway through the first quarter. Seems extremely unlikely to me that we can get above this resistance here. Call it 93 to 95 on TLT. And it seems extremely unlikely at this point that we're going to breach 85 on the downside unless we get the next quarterly refunding announcement we just had. So it's not for a couple more months. And they really turn on the coupon spigot. So range-bound markets on the bond side. Equity markets went up at resistance. The S&P 500 has tried a few times. These are the Qs. The Qs really led the reversal this week. Very, very surprising, but not given the bond response. Can we break out here? We literally touched it. The high back in pre-Powell FOMC hawkishness, 539.15. The high today, 538.84. So we came within a rounding error of that top and a bit of selling late in the day, not really. S&P was flat on the day. If we bring up the spider here and just look at it quickly, again, you can see that we made the high here, touched it, lower high, talked about the reversal last week. We didn't get any downside follow through, but we haven't broken out yet. I don't want to bet that we can't break out here. We certainly can. Markets can stay irrational far longer than you and I can remain solvent. Earnings are okay, and that seems to be what's driving things. In terms of what's in front of us, the next big earnings is NVIDIA, and we're coming up to it. It's not this week, it's the week after. So into the end of the month, if NVIDIA has really great things to say and Jensen does his spin, maybe the markets can break out to the upside. I find it hard to believe that we're going to break out before we hear from NVIDIA at a very minimum. Looks like on the tariff side, President Trump is not wavering, but clearly is talking way ahead of what's likely doable. We did hear this week out of the administration that USTR isn't going to be staffed well enough to implement anything new until April 1st at this point. So again, tape bomb risk. We saw a little bit of that this week, and the markets right now don't care at all about tariffs. So we'll see if it starts to matter at some point. Market really believes it's not going to be an economic shock at this point, given the price action, and that Doge is going to save a lot of money. We saw one analysis this week of the next 4 years of budget deficits from some really smart people, and best case scenario is we take the deficit from 6 and change now down to 475 or 5, best case scenario. So still got a lot of debt in front of us, range bound. Really, really tough environment here to expand multiples. So if earnings can keep firing, great. Initial claims low again, until the labor market breaks, to the downside, the markets are going to see dip buyers. So that's what we're faced with, I think, for the next couple of months here.